Look at what's happening in the silver market right now. While everyone's distracted by the headlines, something extraordinary is taking place beneath the surface. The volume profile data is screaming at us, and if you understand what you're looking at, you'll realize we're witnessing one of the most significant accumulation patterns in decades. Let me show you exactly what I'm seeing, because this isn't speculation. This is hard data from the exchanges, and it's telling us a story that most investors are completely missing. The volume profile is essentially a fingerprint of where the big money is positioning itself. It shows us the price levels where the most trading activity has occurred, and more importantly, where the smart money has been quietly building positions. And right now, that fingerprint is revealing something that should make every precious metals investor sit up and pay attention. Between 2850 and 2980, we're seeing volume clusters that are absolutely massive. We're talking about accumulation zones that dwarf anything we've seen in the past 3 years. This isn't retail investors dabbling with a few ounces. This is institutional-level positioning, the kind of buying that only happens when sophisticated players know something the general public doesn't. Think about what volume profile actually tells us. When price trades at a certain level and massive volume occurs there, it means that level has been accepted by the market as fair value. But when we see this kind of concentrated buying at specific price points, especially during periods when the mainstream narrative is bearish on precious metals, that's when you need to pay attention. Because that's not random. That's strategic positioning. Let me take you back to 2019 for a moment, because there's a parallel here that's almost eerie. In the summer of 2019, silver was trading around $16, and the volume profile showed similar accumulation patterns between $15.50 and $16.80. Most analysts were calling for lower prices. The dollar was strong, the Fed was supposedly done cutting rates, and precious metals were out of favor. But the volume profile told a different story. Someone was buying, and buying aggressively. What happened next? Within 18 months, silver had rocketed to $30. That's an 87% gain. And it all started with those accumulation zones that most people ignored. Now, I'm not saying history repeats exactly, but I am saying that when you see institutional-level accumulation at specific price levels, you need to understand what that means. These aren't amateurs. These are players with research teams, with access to supply chain data, with connections to mining executives and industrial users. They're seeing something in the fundamentals that justifies building these massive positions. So what are they seeing? Let's dig into the supply side first, because this is where the story gets really interesting. Silver mine production peaked in 2016 at about 900 million ounces globally. Since then, we've been on a declining trend. Last year, primary silver mine production was down to around 830 million ounces. That's a 70 million ounce deficit from the peak, and the decline is accelerating. Major silver-producing countries like Mexico, Peru, and China are all reporting lower output. The easy silver has been mined, the high-grade deposits are depleting, and the capital investment needed to bring new mines online? It's not happening at the scale required to reverse this trend. But here's where it gets critical. Industrial demand for silver is exploding. Solar panel production alone is consuming over 150 million ounces annually now, and that number is projected to hit 200 million ounces by 2027. Every solar panel requires about 20 grams of silver. As countries race to meet renewable energy targets, that demand is non-negotiable. They need the silver, regardless of price. Then you have the electric vehicle revolution. Each EV uses roughly twice as much silver as a traditional combustion engine vehicle. We're talking about silver in the electrical systems, in the charging infrastructure, in the battery management systems. Global EV sales are growing at 35% annually. Do the math on what that means for silver demand over the next 5 years. And we haven't even touched on 5G infrastructure, which is perhaps the most underestimated driver of silver demand. Every 5G base station requires significantly more silver than 4G technology. China alone is planning to install over 2 million 5G base stations. The United States, Europe, India, they're all building out these networks simultaneously. This is a multi-year demand surge that's just beginning. Now, here's the thing about industrial demand. It's inelastic. When a solar panel manufacturer needs silver, they can't substitute it with something else. When an electronics company is building circuit boards, they need silver's unique properties. Its electrical conductivity, its thermal conductivity, its reflectivity. These are irreplaceable in many applications. So when supply gets tight, industrial users don't stop buying. They just pay higher prices. The volume profile is showing us that someone understands this supply-demand equation intimately. They're accumulating at these levels because they know what's coming. They're building positions before the broader market wakes up to the reality of the situation. Let's talk about the COMEX for a minute, because what's happening there is absolutely fascinating. Registered silver inventories, the silver that's actually available for delivery, have been declining steadily. We're down to about 45 million ounces in the registered category. That might sound like a lot, but consider this. The open interest in silver futures represents claims on over 900 million ounces. That's a 20-to-1 ratio of paper claims to physical metal available for delivery. Now, most futures contracts are settled in cash, not physical delivery. The system is designed that way. But what happens when even a small percentage of contract holders decide they want actual metal? What happens when industrial users, seeing the supply constraints, decide they need to secure physical inventory? The mechanics of the COMEX become very interesting very quickly. We saw a preview of this in March 2020. Remember when silver briefly spiked to $30 before crashing with everything else? That wasn't just pandemic panic. That was a brief moment when the physical market disconnected from the paper market. Premiums on physical silver coins and bars exploded to 40% over spot price. Dealers were sold out. Mints couldn't keep up with demand. The paper price said one thing, but try actually buying physical silver at that price. It was impossible. The volume profile accumulation we're seeing now suggests that sophisticated players remember that lesson. They're not waiting for the next supply crisis. They're positioning ahead of it. And here's something most people don't realize about silver. It's consumed. Unlike gold, which is mostly held in vaults and recycled, silver gets used up in industrial applications. It's in your phone, your computer, your car, your appliances. When those products reach end of life, the silver isn't economically recoverable in most cases. It's gone. Every year, hundreds of millions of ounces of silver are consumed and effectively removed from the available supply forever. The recycling rate for silver is only about 30%. Compare that to gold, which has a recycling rate over 90%. This means that industrial demand is constantly eating into the available supply, and that silver isn't coming back to the market. Now, let's talk about what central banks are doing, because this is where the monetary angle comes into play. While central banks don't typically hold silver reserves the way they hold gold, they're acutely aware of the gold-silver relationship. And right now, the gold-silver ratio is telling us something important. Historically, the gold-silver ratio has averaged around 60-to-1. That means it takes 60 ounces of silver to buy 1 ounce of gold. Right now, we're trading around 85-to-1. Silver is historically cheap relative to gold, and with gold making new all-time highs, pushing past $2,700 per ounce, the mathematical catch-up trade in silver becomes increasingly compelling. If silver were to revert to even a 70-to-1 ratio with gold at current levels, we'd be looking at silver prices around $38. That's a 35% gain from current levels. And if we see a move back to the historical 60-to-1 ratio, we're talking about $45 silver. These aren't wild predictions. This is just mean reversion to historical norms. But here's what makes this moment different from previous cycles. The industrial demand story is stronger than it's ever been. In previous silver bull markets, the price was driven primarily by investment demand and monetary concerns. This time, we have genuine, structural industrial demand that's growing exponentially. That puts a floor under the market that didn't exist before. Think about a solar panel manufacturer in 2025. They have contracts to deliver panels. They need silver to produce those panels. If silver goes to 35, 40, even 50, they still need to buy it. They'll pass the cost on to their customers, but they can't stop buying. That's what inelastic demand means. And that's what makes this setup so powerful. The volume profile is showing us that someone gets this. They're accumulating at these levels because they understand that the risk-reward is extraordinarily skewed to the upside. They're willing to build large positions in the $28 to $30 range because they see the potential for 40, 50, maybe even $60 silver over the next few years. Now let me pause here for a second, because if you're someone who's thinking about wealth preservation, about protecting your purchasing power in an environment where currency devaluation is accelerating, this matters to you. And if you have $100,000 or more in retirement accounts, you might want to know that there are ways to hold physical precious metals in tax-advantaged accounts. I put together a free guide on how gold IRAs work, how you can get physical gold and silver into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if that's relevant to your situation, because the window to position yourself ahead of these moves doesn't stay open forever. All right, back to the volume profile and what it's telling us about the immediate future. When we look at the price action over the past 6 months, we can see that every time silver has dipped below $29, it's been met with aggressive buying. The volume spikes at those levels are unmistakable. This isn't weak hands selling into strength. This is strong hands buying the dips. And that creates a technical setup that's extremely bullish. In technical analysis, we call these areas of high volume value areas or points of control. They represent price levels where the market has found equilibrium, where buyers and sellers have agreed on fair value. But when you see accumulation at these levels, when you see volume increasing as price dips, that tells you the equilibrium is about to shift higher. Think of it like a coiled spring. The more energy that gets compressed into a tight range, the more explosive the eventual move becomes. Silver has been consolidating in this $28 to $31 range for months now, all while this massive accumulation has been taking place. That's not a topping pattern. That's a launching pad. And we can see this in the futures market positioning as well. The Commitment of Traders report, which shows us how different categories of traders are positioned, reveals that commercial hedgers, the producers and industrial users, have reduced their short positions significantly. They're less bearish than they've been in years. Meanwhile, large speculators, the hedge funds and commodity trading advisors, are still relatively underweight silver compared to historical norms. What does that mean? It means there's still a massive amount of buying power on the sidelines. When those large speculators start to pile in, when the momentum traders see silver breaking out to new highs, that's when you get the parabolic moves. That's when silver goes from $30 to $40 in a matter of weeks, like we saw in 2020, like we saw in 2011, like we saw in every previous silver bull market. The volume profile is showing us that the foundation is being built right now. The smart money is positioning. They're not waiting for confirmation. They're not waiting for CNBC to tell them silver is breaking out. They're buying now, while the price is still in this accumulation zone, while the general public is still skeptical. Let me give you another historical parallel, because this is important. In 2010, silver was trading around $18. The volume profile showed similar accumulation patterns. Most mainstream analysts were dismissive. They said silver was a barbarous relic, that industrial demand was weak, that there was no reason for prices to rise. But the volume profile told a different story. Someone was buying, and buying aggressively. What happened? Within a year, silver had rocketed to $49. That's a 172% gain. And it started with those same accumulation patterns we're seeing today. The smart money positioned early, and when the broader market finally recognized what was happening, the move was explosive. Now, I'm not predicting we're going to $49 tomorrow, but I am saying that the setup is remarkably similar. We have supply constraints, we have surging industrial demand, we have a gold-silver ratio that's historically stretched, and we have volume profile data showing massive accumulation. All the ingredients are there. And here's something else to consider. The geopolitical environment is increasingly favorable for precious metals. We're seeing de-dollarization accelerating. The BRICS nations are actively working to reduce their dependence on the US dollar for international trade. They're settling transactions in local currencies. They're building alternative payment systems. And they're accumulating gold reserves at record pace. China's central bank has been buying gold for 18 consecutive months. Russia has been a consistent buyer. India, Turkey, Poland, Singapore, they're all adding to reserves. Why? Because they see the writing on the wall. They understand that the era of unchallenged dollar dominance is ending, and they're positioning for a world where hard assets matter again. Silver, as gold's little brother, benefits from this trend. When confidence in fiat currencies erodes, when people start questioning the sustainability of government debt levels, when inflation concerns resurface, precious metals become attractive. And silver, with its dual nature as both an industrial metal and a monetary metal, offers unique leverage to these trends. The volume profile is capturing all of this. It's showing us that informed players are accumulating ahead of what they see as an inevitable repricing of silver relative to both fiat currencies and relative to gold. They're building positions now, while the price is still reasonable, while the mainstream is still skeptical. And let's talk about the mining sector for a moment, because what's happening there reinforces the bullish case. Primary silver miners, the companies that produce silver as their main product, are trading at valuations that are historically depressed. The average silver miner is trading at less than 10 times earnings, with many trading at single-digit multiples. Compare that to the broader market, where the S&P 500 trades at over 20 times earnings. Why are silver miners so cheap? Because the market doesn't believe in higher silver prices. The market is pricing in a scenario where silver stays range-bound or declines. But if silver breaks out to $35, $40, $45, the earnings leverage in these mining companies is extraordinary. A 50% increase in the silver price can translate to a 200 or 300% increase in mining company profits because their costs are relatively fixed. The volume profile accumulation we're seeing in silver itself is likely being mirrored in the mining stocks, though that's harder to quantify. But the logic is the same. Smart money is positioning ahead of the move, buying when valuations are depressed, building positions before the broader market recognizes the opportunity. Now, let's address the elephant in the room. What could go wrong? What are the risks to this bullish thesis? The main risk is a deflationary collapse, a scenario where economic activity contracts so severely that even industrial demand for silver falls. We saw a preview of this in March 2020, when silver briefly crashed to $12 as liquidity dried up across all markets. But notice what happened next. Silver recovered within weeks and went on to make new highs. Why? Because the policy response to deflation is always massive monetary stimulus, which ultimately benefits hard assets. Another risk is a technological breakthrough that reduces silver usage in key applications. But this seems unlikely in the near term. Silver's unique properties make it irreplaceable in most current technologies, and even if substitutes are developed, the transition would take years or decades. The third risk is a massive increase in mine supply. But as we discussed, mine production is declining, not increasing. The capital investment needed to reverse this trend isn't happening. And even if it were, it takes 7 to 10 years to bring a new mine from discovery to production. The supply deficit is here now. So when we weigh the risks against the potential rewards, when we look at the volume profile data showing this massive accumulation, when we consider the supply-demand fundamentals, the technical setup, the geopolitical backdrop, the historical parallels, the picture becomes clear. Silver is setting up for a significant move higher. The smart money is positioning now. They're not waiting for confirmation. They're not waiting for the breakout. They're accumulating at these levels because they understand that the risk-reward is extraordinarily favorable. The volume profile doesn't lie. It's showing us where the big money is positioning, and it's showing us that they're building positions aggressively in the $28 to $30 range. These are the levels that will likely be looked back on as the launching pad for the next major move in silver. And here's the thing about these accumulation phases. They can last longer than people expect. The smart money is patient. They're willing to accumulate for months, even years, if that's what it takes to build their positions at favorable prices. But eventually, the accumulation phase ends. Eventually, the price breaks out of the range, and when it does, the move is typically swift and powerful. We're seeing all the signs that we're in the late stages of this accumulation phase. The volume profile is showing us that the foundation has been built. The technical setup is bullish. The fundamentals are supportive. The geopolitical environment is favorable. All the pieces are in place. The question isn't whether silver is going higher. The question is whether you're going to position yourself ahead of the move or wait for confirmation and pay higher prices. The volume profile is giving us a roadmap. It's showing us where the smart money is accumulating. It's showing us the levels that represent value in the eyes of informed, sophisticated players. These are the levels, between $28 and $30, where massive accumulation is taking place. This is where the foundation for the next bull market is being built. And if history is any guide, If the patterns we've seen in previous cycles repeat, the move from here could be substantial. The data is clear. The volume profile is screaming at us. The smart money is positioning. The only question is whether you're paying attention.